Hi everyone online. Thank you for joining us for the Junior Scholar Colloquia today. I have with us Dr. Jeleta Kebede. I hope I pronounced that correctly. We're happy to have you with us here today for the talk and we're excited for your talk.
Okay. Thank you, Mel, for the introduction, and thank you, everyone. Good morning, everyone. Thank you for coming to attend my presentation today. So, yeah, I will be talking on demand for inclusive insurance, the effects of risk and insurance attitudes. So this is a project on which I've been working for the last 2 months. Actually, this project was undertaken by cars, and there was a report for related to the project, and I'm preparing this one for publication as in the form of journal articles. So that's what I'm doing. So yeah, so I will be talking the motivation, what motivated us to undertake this research, and then talk about the methodology that we employed for this study, and then discuss the results and conclude. Okay. Come to the motivation. So we know that United Nations have adopted, this Sustainable Development Goals in 2015, so as to achieve some goals, like 17 of them by 2030. They developed that based on the achievements of the Millennium Development Goals, while also, including additional goals. Some of these goals are like, for example, eradicating poverty, which is goal 1, I think, and reducing inequality between and among countries, which is goal 10, and there are other goals as well. So actually, financial inclusion is not among the goals, but it's considered as one of the most instrumental variables so as to achieve the other goals. Therefore, of course, this sustainable development goals revolve around some fields like inclusion, resilience, and sustainability, and therefore financial inclusion. So in the form of accessibility, availability, and the usage of bank products and insurance products are thought to be helpful so as to achieve those goals of achieving inclusion, resilience, and sustainability. So we know that these issues like inequality and the poverty appear to have different faces in different contexts, particularly when we see them from the perspective of developing and developed countries. And the people might think that this inequality and the poverty are agendas of developing countries, but they are also some of the main agendas of developed and advanced countries. Because literature shows that inequality has been increasing in developed countries and in advanced countries as well. Particularly recently, after this financial crisis that happened in 2007, 2008, 9, and also that has created a lot of structural changes in the economies of developed countries, and has triggered the inequality to exacerbate. But on top of that, the COVID that we experienced recently, and also the kind of increment in the price of goods and services in the last couple of years, due to high inflation, has also exacerbated the problem of inequality, and that has also eroded the social safety net, because they have stressed the fiscal capability of governments. Therefore, this issue of poverty and inequality, therefore, is not the problem of developing countries only, but it is also the problem of advanced countries. And Canada is not a country which is immune to that. So Canada also experiences increments in inequality. What we therefore posit is that for financial inclusion, particularly in the form of inclusive insurance can help, in addressing those problems, which are inequality and poverty, not only in the context of developing countries, but also in the context of the advanced countries as well. So, but therefore, inclusive insurance actually, can help, different segments of society in different ways. The one is it can, create, affordable, accessible, and usable, insurance products to people who are either completely unserved or underserved. And in doing so, they can, enhance the resilience. Therefore, resilience of economic agents to different shocks. These shocks being either idiosyncratic shocks that are confined to individuals, or maybe like common shocks, which are common to many. So, say for example, according to the Geneva Association's 2024 report, inclusive insurance might play different roles in different countries, particularly in developing countries context. So, in developing countries, inclusive insurance mainly helps in alleviating poverty. So, it's considered as an instrument to alleviate poverty for particularly people who are completely unserved. That is, for people or maybe segments of population who are completely excluded from accessing insurance. But in the context of advanced economies, inclusive insurance might serve particularly those segments of the population who are underserved. That is, they might have access to some types of insurance, but they might be underserved. And those populations, particularly in the context of developed countries, might not be only low income, but they might be also middle income, but at the same time, they might be experiencing, the different barriers as far as, accessing inclusive insurance is concerned. So therefore, inclusive insurance might, help in achieving the sustainable development goals, and in benefiting different segments of the society. Like I discussed, there is no general consensus as far as what inclusive inclusive insurance research is, and therefore there is no well agreed upon definition of what it is. So different people define differently. Say, for example, if we follow the the Geneva Association 2024 report, they define inclusive insurance as all insurance products that target either completely excluded people or people who are underserved, rather than defining it narrowly by focusing on the people who are falling in the category of low income groups. That is, and therefore not only that, like focusing on people who are at the top, at the bottom of the pyramid, considering it from the broadly from the point of view of people who are either unserved or underserved is the kind of definition that they are tied to it. But I'm not saying that this is the only definition, but others also define differently, but depending on either the target population or the principles that should be governing inclusive insurance. So this inclusive insurance, particularly in the form of micro insurance, has recently, particularly in the last decades, dramatically increased in the context of developing countries, but in the context of developed countries, that they have not made the way, and therefore it is a puzzle. Therefore, despite its importance, the fact that it is not making its way in the context of developed countries is a puzzle, and therefore we argue that so as to enhance the promotion of inclusive insurance, particularly in the context of developed countries, it is essential to understand the main barriers that are there as far as the demand for inclusive insurance is concerned, particularly from the context of the target groups, with those target groups being mainly the low income and the medium income economic agents, primarily households, and therefore doing that would help. One in it might help the supply side of insurance, so as to design and provide the kind of insurance that best works for the people under consideration. And the two, it might also help just to undertake some sort of behavioral and attitudinal changes, particularly from the perspective of the households. And therefore, under this context, we are against this background, our objective here is to undertake the analysis related to the impact of attitudes toward this participation in inclusive insurance and the willingness to pay for insurance by focusing on attitudes toward this risk and attitudes toward this insurance. I'll be discussing in a moment attitudes toward this risk and attitudes toward this insurance. And then we also want to undertake the analysis whether these attitudes do differently affect the participation decision and the willingness to pay. And also whether the effect of these attitudes, conditions on the kind of risk experience that economic agents might have experienced. I will talk about the risk experiences that I mentioned here. Okay, here I talk briefly about the methodology that we employed. So as far as the data is concerned, we rely on survey data of 2,143 households, which fall in the category of low to middle income from Canada in 2019. So as far as the method of data analysis is concerned, we use factor analysis to index attitudes towards risk and attitudes towards insurance. And then we use probit model mainly. Actually, we'll be using some other method as well that I will be talking just after robustness check, but probit model so as to model the participation decision in insurance. And as far as the intensity decision that is the willingness to pay is concerned, we will be using our probit model. Yeah. So I will just before going to the analysis, I would rather focus on maybe like three main variables of our interest. One is the main independent variable, which we call attitudes. So we just develop, the index of, attitude here. And I start with the main independent variable of our interest. Therefore, households have been, asked different questions related to their perceptions and attitudes about, about insurance and about risk, and they were therefore asked to whether they strongly agree with these indicators, or whether they somehow agree, whether they are neutral, whether they strongly disagree, or somehow disagree. And therefore here this depiction is by only using three main indicators, meaning we just present this strongly agree and they agree in the form of only agreement. Therefore agreement represents both who say they strongly agree and who say they somehow agree. Disagreement captures those households who say they strongly disagree or somehow disagree. Okay, and therefore we just present here some sort of how to say the frequency. Okay, say for example, if we just say for example see this indicator which says insurance is expensive, what we see is around like 79% of the respondents say that they agree that insurance is expensive, whereas only like 6% of them say that they disagree with that. So like say for example, if we see, say for example, the main purpose of insurance is to provide protection against adverse events, we see that around 83% of the households agree with that, whereas like 6% of them disagree with that. So that we have, say for example, therefore this shows the frequency of how our respondents respond to attitudes towards indicators of perceptions and attitudes of individuals toward this risk and insurance. So here we have like 13 different indicators, and using these many indicators to model the participation decision and the willingness to pay might be creating different problems, like for example, over parameterization problem and the multicollinearity problems, and therefore we rather prefer to index these attitudes by using maybe like for example unobserved variables which are of lower level in terms of numbers from potentially from compared to the number of indicators that we have here. And therefore, so as to index that we employed factor analysis. So of course there are different competing ways of indexing, but we just relied on factor analysis because the kind of damage that we have is not abnormal. So therefore, here is the result of the factor analysis. So from the factor analysis, we found that we have 3 factors. So say for example, in the case of factor 1, what we see is this is a logic, result from factor analysis, and therefore this below ones for factor 1, say for example, indicates the indicators that explain factor 1. And these are indicators like AS1, AS2, AS6, AS8, and AS10. These indicators are indicators which mainly show the positive attitude of the respondents toward this insurance sector. Therefore, say for example, AS1 says insurance are stable financially and they cannot go bankrupt easily. So it is like a positive view that people have toward this insurance. Say for example, S6 is, say for example, insurance is a good use of money, which is again a positive perception of the respondents that about insurance. Therefore, we define therefore factor 1 as a positive attitude toward this insurance, which is a function of therefore these 5 indicators. Here is factor 3. So factor 3 is mainly explained by two indicators. One of them is AS5, which is insurance sometimes manipulate conditions or treat people so they don't have to pay, meaning that it is a negative view toward this insurance, right? Because people perceive that insurance companies will treat people rather than so as to avoid like paying, and therefore it is a negative view. And the insurance is expensive, which is S7 is again a negative view about insurance, right? So we just therefore proxy this by a negative attitude toward this insurance. Whereas factor 2 represents it captures 2 variables mainly, which is one is AS4, which is about the likelihood of something serious happening, and the people, say for example, it does not make sense to insure as the likelihood of something serious happening to my family or me is low, which is positive predisposition toward this risk as far as the likelihood of happening is low. Whereas the other one, say for example, the last one is 11, says it does not make sense to insure because we can manage problems ourselves. This is a positive predisposition about toward this risk as far as managing one's own problems is concerned, and therefore we call these two as risk comfort. That is risk comfort from 2 points of view. One is from the likelihood of risk event is happening, and the 2 is even if something serious happens, the likelihood of managing those serious problems oneself. That is thinking that there is no need to rely on external funding. Okay, so therefore we are now developing therefore these 3 main indexes. 2 of them are attitudes toward this insurance, and one is attitude toward this risk. So this is something called a risk comfort, and therefore it has something to do with some sort of attitude toward this risk. Or we know these things like risk loving, risk averse, and risk neutral behavior. Actually, this doesn't directly say that this risk comfort is about risk learning, but it is positively correlated with that, therefore. So two variables we have, which are not, captured by these factors. We call them risk neutral because, say, for example, AS3 and the AS9, they just only talk about the functions that insurance companies give, and therefore it is not about, positive, negative, or the view, but it is only just, the indicator that they are only indicators about the functions of insurance, and therefore, in the second stage of indexing, therefore, in the first stage of indexing, therefore, we just define, therefore, the factors that determine. So, say, for example, indexes like positive attitude, which is S1, S2, S6, S8, and S10 are the ones that define positive attitude, right? In the second stage, what is the kind of weight that is attached to these, different indicators in defining positive attitude is the issue. For simplicity, we just use, equal weighting. Of course, there might be other, say, for example, competing, like how to say views as far as attaching the weight to each indicator is concerned. But we just used equal weighting approach. Okay. Yeah. So now, having defined our main independent variable, which is the attitudes toward this risk and attitude toward this insurance, the next stage is we just therefore developed our dependent variables, the main outcome variables, which are participation in insurance, that is participation in purchasing insurance, and the willingness to pay. So as far as participation decision is concerned, how our respondents were asked different questions, right? Different questions related to first, they were asked whether they have had these types of insurance like non-government health, government health, disability or accident or life, and the other insurance types. So they were asked whether they have had that kind of insurance, and then if they say yes, who paid for that kind of insurance? Did they pay themselves, that is, policyholder paid it, or someone outside the household paid, like, say, for example, employer paid it? Okay, and then on the second step, they were asked whether, say, for example, for who say someone outside household paid it, whether the insurance still exists or whether they are no longer there. And for those who say that the policyholder paid, whether it is still there or whether no more. So those kinds of questions were asked. Say, for example, making this a bit clearer. Say, for example, for the case of non-governmental health, what we see is like these figures are in percentage. Say, for example, 19.5 said, they had the insurance, and that insurance has been paid by someone outside the policy, the household, meaning that, say, for example, employer might have paid it, and 19.5 of them, therefore, they say still the insurance is there, while 1.54% of them say, it is no more there. Say, for example, for the case of policyholder, paid 21%, 21.3% of them say they had the insurance, and it is paid by the household, that is internally funded, and it is still there, while 2.1% of them say they had at one time in the past, but there is no more there. Okay. So why did we do this? We did this so as to develop therefore an indicator of the variable for participation decisions. Two variables therefore. One is a dichotomous variable, which is 1, 0, 1 for those who have participated, and the 0 for those who have not participated in the insurance, right? So the other way of developing a variable from this one is we just develop it can help us also to develop a non-ordered categorical variable. For example, is insurance which is covered by external fund, that is someone outside the household paid, or which are internally covered, and the 0 coverage. That is therefore to make some sort of comparative analysis of people who have internally covered their insurance against those who have been covered by external body and who have no insurance at all. Actually, I'm not going to present this one, which we use the comparative analysis using multinomial logic, but I will be presenting only something we used as that we presented using probit model for the dichotomous variable. So coming to the measure of intensity, that is the willingness to pay. That is the amount, okay, that people are willing to pay. That is the premium in a sense. We measured this okay, using two processes actually. So the thing is, households were asked, about different policies, insurance policies. Say, for example, for different types of policies. Say, for example, for injury policy, they were asked, say, for example, saying that if you get injured and under two different covers, therefore, okay, we have this high coverage and the low coverage. So in the case of low coverage, say, for example, something we say $1,000 per month, households were asked like, okay, if you get injured and you cannot work, you will be paid like, say, for example, 1,000 per month until you recover, or at least for 2 years. And for this kind of insurance, are you willing to pay, say, for example, $70 was what they were asked. And if they say yes, we stop there. But if they say no, further question was asked, therefore, how about 15 by reducing the amount of premium, therefore? If they say okay, we stop there. But if they say again no, if they were asked, how about, okay, if it is 13? And if they say no to that as well, okay, the last question was open-ended question, therefore, how much are you willing to pay them? Okay, and therefore they can say any amount, therefore, less than 13. So for the case of high coverage, now a high coverage policy was introduced, therefore, like $2,000, okay, per month will be paid if they encounter injury. And for this kind of policy, they were asked, are you willing to pay 27 premium per month? And if they say yes, we stop there. If they say no, we ask about 24. If they say no again, how about 21? If they further say no, how much are you willing to pay? Then open-ended question. Okay. This way, we just develop the same, similarly for the case of critical illness and the life insurance, therefore, using high coverage and the low coverage. Okay. And in doing so, we developed like two different variables. One is something we call seemingly continuous variable, seemingly continuous because it's not fully continuous because we have, truncation, something we call left hand censoring and right hand censoring, because from the left hand it is 0, from the right hand it is the highest premium to the respective insurance, right? So it is seemingly continuous. And the other variable that we developed is something we call categorical variables, which is something a kind of ordered category, which is for the highest premium we call it rank 5. This one for the second highest premium is rank 4. For the third highest premium it is rank 3. And then the open-ended questions we categorize them into two ranks. The lowest by dividing into two. For example, in the case of injury premium, injury, for example, for the low coverage, which is 1,000 per month. So for example, the third category is $13. So we divide $13 into two, therefore this 6.5. So for people who are willing to pay between 6.5 and 13, we call it rank 2. For those who are willing to pay less than 6.5 and greater than 0, we call it rank 1. And therefore this helps us to order, okay, the premiums, right, that people are willing to pay. And therefore that enables us to use something we call ordered probit and the probit models to undertake. Ordered probit for the case of ordering categories 5 to 0, and then the probit model for the case of seemingly continuous variables. Okay. We used also some, in addition to our main independent variable, which is attitudes towards risk and attitude towards insurance. We have used also some other, independent variables in modeling the willingness to pay and the participation decision. So one of those variables is risk events. So households were asked about the kind of risks that they encounter, risks related to their health and risks related to, say, for example, accidents, and the risks related to also life. So they were asked whether, say, for example, in the case of risks related to health, whether they encounter, say, for example, chronic and non-chronic illnesses in the last 3 years. For the case of disability, whether they encountered or experienced, say, for example, permanent or non-temporary disabilities in the last 3 years. And for the case of health, then whether they have experienced loss of life in the last 5 years. So we use this because we see, as I will be discussing later, we know that the kind of risk experience that households have encountered might shape their participation in insurance and the willingness to pay. So on top of that, we also just used some control variables related to, say, for example, socio-demographic characteristics of the individual respondent, and the contextual variables that explains the mainly about the household, not necessarily about the individual respondent. Okay. So now coming to the main results. Therefore, so far I was trying to explain the main variables that we use, mainly the independent variable, which is attitude towards risk and insurance, and the dependent variables, which are participation decision and the willingness to pay. So now we are modeling this participation decision, therefore using mainly probit model, because our dependent variable is dichotomous, meaning that it takes a value 0 for people who are not participating in insurance, and a value 1 for those who participate. And therefore we use probit model. So I'm just this is presenting only the coefficients and the significance levels. I'm not quoting the standard errors because of space. So and I will be focusing mainly on our variables, which are the risk attitude and the attitudes towards insurance. I will not be dwelling on the other variables actually. So yeah, so what we see is here we have no, my cursor is able to you guys. So here, if say for example negative attitude toward this risk, if you see that this negative attitude toward this risk doesn't have any significant effect on health insurance. Health insurance here is the non-governmental health insurance actually, and on disability or life, it doesn't have any significant effect. That is, people's attitude toward this insurance, negative attitude doesn't have significant effect. Whereas positive attitude here, it only significantly affects the participation decision in non-government health, not in others. That is, it is positive and significant, saying that meaning the more the positive attitude towards these insurance companies, insurance sector in general, the more people are willing to participate in purchasing non-governmental health insurance. So the main variable that we are interested in here is the risk comfort attitude. That is individuals' attitude toward this risk. As we can see here, I don't know. So we see that the risk comfort has consistently negative and significant effect on participation decision. So meaning that the more people develop a risk comfort attitude, the less that they will be willing to participate in purchasing insurance. Yeah, this should be intuitive because we say that risk comfort captures two things. One, captures the likelihood of risky event is happening, serious event is happening. Two is the likelihood that the households themselves can manage it if it happens. So the more people think that the likelihood of serious event is happening is low, and the more they think that even if it happens, we can manage it, the less they will be willing therefore to participate in insurance, because they just think that it is less likely that it will be happening, and even if it happens, we can manage ourselves, and therefore there is the likelihood that they would resort or external funding to manage, and therefore that makes sense, and it is intuitive, I think. And then we just further undertook the analysis using another estimation approach, which we call conditional mixed processing process. Why do we do this? We do this because the decision making of participation in these different insurances, whether it is non-governmental health, disability, or life insurance, is a kind of something that might be jointly made, because they are all the outcomes of the same constraint optimization that household space, right? And therefore, the decision in one area might be, interrelated or correlated with the decision in the other area. And therefore, we allow this correlation to happen through the error terms of these equations. Like the error terms, I mean, is, because when we are modeling this participation decision, we have, error terms, which that captures, the other variables that have not been made part of the model. And therefore, we reported, therefore, this results related to, the conditional mixed process, columns 4 to 6, present the result, and the result is something robust, that because what we see is, the risk comfort again significantly and negatively affected the participation decision, and what is interesting here is this result related to the correlation coefficients between error terms. So say, for example, if we take the correlation, the first correlation coefficient reported here, 0, 1, 2, it captures the relationship that is there, the correlation between the error term of equation 1 and the error term of equation 2, meaning the error term which is associated with non-governmental health and the error term which is associated with disability. So this value is significant and positive, meaning that implying that the participation decision in the non-governmental health is highly correlated with the participation decision in the disability insurance, and therefore there is a tendency for these participation decisions across different areas to be correlated, and the coefficient related to the error term 1 and 3 and the error term 2 and 3 also show relatively qualitatively similar results. So based on the probit result, we developed here something we call predictive probabilities. So at different values of the risk comfort, the risk comfort ranging from -2 to 2, 2 being the highest risk comfort, -2 being the least, meaning because we just of course we captured these indexes using these indicators from strongly disagree to strongly agree. So we just define numerically between us -2, -1, 0, 1, 2. Therefore, 2 being those who have the highest risk comfort, whereas -2 being those who have the risk comfort in terms of the magnitude. So what we see is here, the lower the risk comfort, okay, they have the predictive probability, meaning that people who have relatively less risk comfort tend to participate more in insurance decision. But as the risk comfort increases, the predictive probability of individuals participating in insurance will be decreasing and decreasing. Okay, so that is what it shows. And the other interesting point that this figure shows is that this predicted probability related to life insurance is very steep, and indicating that life insurance is highly responsive, very elastic it is, and highly responsive to risk comfort. Therefore, meaning that if a risk comfort changes by a certain magnitude, the responsiveness of participating in life insurance would be say for example dropping by large magnitude, say for example in the case of increment in risk comfort. So like I said, this is the probit model is not a dependent variable, is not a continuous variable because it is 0, 1, and therefore the coefficients related to this probit model do not show the marginal effect, and therefore we computed something we call average marginal effect, which shows exactly the magnitude by which the probability of participation change if risk comfort changes by 1 unit. Say, for example, if risk comfort increases by 1 unit, say, for example, from minus from, say, for example, 1 to 2, what it shows is the probability of participation in non-governmental fields will be decreasing by 0.536. And in the case of life insurance, it will be decreasing by 1.388. This result shows that the risk comfort has relatively the highest effect on the case of life insurance as compared to non-governmental health and disability insurance. Now we now try to analyze whether this risk comfort effect on participation decision depends on the risk event experience of households. The literature shows that people who have some sort of shock experience tend to participate in insurance more compared to people who have not experienced any risk. But we argue that, of course, that is what our result also shows here. So what we see is, for example, if we see health risk event here, which is chronic 3.1, the H risk 3 is the household's experience with chronic illness, while, say, for example, H risk 4 is with non-chronic illness. We see that people who have experienced health risk are relatively more willing to participate in purchasing insurance as compared to people who have no experience who have not experienced any health event, right? So literature shows that, but we just further argue that risk event doesn't only directly affect the participation decision in purchasing insurance, but it can also impact the participation decision through its impact on individuals' perception about risk, right? So what we mean is like individuals who have experienced some sort of shock in their life, whether that is in our case, this idiosyncratic shock, actually even in some sort of common shock, they may develop a tendency of low positive predisposition toward this risk. That is, their perception that the likelihood of serious things happening to their life will be decreasing the more they are exposed to risk, therefore. And their tendency to be confident that they will manage the risk themselves might decrease as well. And therefore, we just developed interaction between risk event and the risk comfort, therefore, so as to see if the effect of risk comfort attitude on participation decision depends on risk experience of our sources. So this is the result that we have, particularly in the case of health risk here. Actually, health risk is, in this case, it is a combination of the two, whether an individual has experienced either chronic disease or non-chronic disease. What we see is here risk comfort has positive and negative and significant effect. That is, the more risk comfort an individual is, the less he or she is willing to participate in decision in insurance purchasing. And here the interaction term, right? The interaction term shows that the interaction term between health risk event and the risk comfort is, the effect is positive. That is, as compared to people who have not experienced any sort of health problem. Okay, those who have health problem, who have experienced health problem, conditioned on their risk comfort, they tend to participate more in purchasing, insurance, whether that insurance is non-governmental health insurance or disability insurance, life insurance. And therefore, we argue that when individuals experience some sort of health problem, okay, their predisposition toward this risk will be changing. Okay, it might be impacted, and through that, their decision to participate in purchasing insurance will change as well. And therefore, what this result tells us is the effect of risk comfort on participation decision depends on whether individuals have encountered some sort of risk events or not. Okay, so now we deal with the willingness to pay. That is, so far the discussion was whether individuals will be willing to participate in insurance. In purchasing insurance. It doesn't say anything about how much they will be willing to pay. It doesn't tell us anything about their willingness to pay. That is the intensity to pay. But only, okay, it's all about, you know, the participation decision, whether they will be willing to purchase insurance or not. Now, we discussed about the magnitude, therefore, that is the willingness to pay, the intensity to purchase. So as to do this, we rely, therefore, on two proxies that I was just discussing here. The proxies which are, one is the seemingly continuous variable, which is the premiums from, say, for example, in the case of, you know, injury for the lower coverage, that is $1,000 per month, the values being from 17 to 0, therefore seemingly continuous. And the other variable is something we call ordered category variables, which ranges from 5 to 0. Okay, and therefore now we present in this case using, you know, something we call ordered probit for the categorical variables that ranges from 0 to category 0 to category 5. Category 5 being the highest premium, whereas category 0 being those who are not willing to pay anything, meaning that those who are paying 0. Whereas category 4 being the second highest premium, category 3 being the third highest. Okay, so we present here the result for also for policy 1 and the policy 2. Policy 1 being the low coverage and the policy 2 being the high coverage. What I mean by this is, for example, here in the case of injury, in the case of injury, policy 1 is, which is $1,000 per month, whereas which is low coverage, whereas policy 2 is $2,000 per month, which we call is high coverage, and the similar thing holds for the other coverage as well. So the result related to probit model, ordered probit model rather, indicates that you know, say for example, positive attitude, it has positive and significant effect under all you know the areas of coverage, both in the case of low coverage and high coverage. What this shows is the more the positive attitude that people might have towards insurance, the higher that they will be willing to pay, the higher the premium that they will be willing to pay. Right? Whereas in the case of the negative attitude, what we see is the more people develop a negative view about insurance, the lower the amount of premium that they would be willing to pay, because it has negative effect. But if we are making a comparison between, you know, in terms of the absolute value related to positive attitude and the negative attitude, what we see is, you know, having a positive view towards this insurance has relatively higher effect, okay, on willingness to pay. That is, in absolute value, okay, the magnitude is higher, meaning that having a positive view has higher effect on the willingness to pay compared to having the negative view. So the effects are opposite. Whereas in the case of risk comfort, what we see is risk comfort has again negative and significant effect, but only mainly under the case of high policy, not in the case of low coverage policies. So what we saw is in the case of the participation decision, we found that having a positive view or a negative view towards this insurance doesn't as such have significant effect. What has significant effect as far as participation decision is concerned is relatively risk comfort, that is a view rather an attitude towards this insurance, towards this risk rather than attitude towards this insurance. But in this case, in the case of willingness to pay, both attitude towards this insurance and the attitude towards this risk have, you know, significant effect on the willingness to pay. Okay, we can make some sort of comparison as far as this the effect of, you know, attitude towards insurance and the attitude towards this risk is concerned on the case of low policy, low coverage and high coverage as well. So we just also considered here whether the effect of risk comfort depends on risk experience, therefore. And the result shows, at least in the case of disability risk, that is for individuals who have experienced either permanent disability or temporary disability, the effect of risk comfort depends on risk experience. Meaning, while the risk comfort has negative effect on the amount of the premium paid, the interactions are between risk comfort and risk event, particularly in the case of disability, has positive effect. So now this is the result related to Tobit model, because here we have some sort of censored values for something I was calling saying seemingly continuous variable, because it is censored from from top and from bottom as well. That is from left hand and right hand, like I was saying, because here if you say for example use life insurance, right, for the case of low coverage, which is 10,000 lump sum. What we see is the for different categories of age. Say for example for age 35 to 44, it is censored from the right hand side because the mark is 9, and from the left hand side is 0, and therefore it's not continuous, rather it is seemingly continuous, and therefore we rely on Tobit regression because the dependent variable is a bit truncated, and our result shows here that the positive attitude therefore has positive and significant effect on the willingness to pay, density to pay, whereas negative attitude has a negative effect, and the risk comfort has negative effect as well. So here this Tobit model, therefore, in the case of ordered Tobit model, the result shows only the direction of the effect, and it doesn't the results do not tell us the marginal effect, right? But in the case of Tobit model, what we have is the results tell us the marginal effect, and therefore they tell us the real monitored value. That is, say, for example, in the case of positive attitude, say, for example, for injury and the policy one, this 2.267 shows that if, say, for example, positive attitude increases by 1 unit, the amount of premium that people are willing to pay will be increasing by $2.267. Okay, so it tells us the magnitude. Okay, and in the case of the negative attitude, say, for example, corresponding to the injury policy one, if negative attitude towards insurance increases by 1 unit, say for example from say for example 0 to 1, or from 1 to 2, other thing is being constant, what tells us is that the amount that people would be willing to pay, the amount of premium, therefore would be decreasing by $1.962. Okay, that is what it shows, and the result also shows that as the conditionality of the effect of risk comfort on risk events are concerned, while the risk comfort has negative and significant effect, this effect depends on as well on risk event, particularly in the case of disability risk. Yeah, so yeah, that is all. So yeah, I should stop here, maybe so as to entertain some of this. Thank you.
Thank you, Jeleta, for such an interesting talk. Does anyone have any questions?
I do, but maybe if someone else does as well, I'll wait.
Yes, Robert, go ahead.
Yeah, morning. I mean, this question might be a little bit trivial, but I was curious to know what exactly drives this willingness to pay. Is it more about affordability? Is it, I guess, I don't
Sorry,
know.
Robert, we can't really hear you.
Are you guys hearing any better? Okay, yeah, I was saying, I was wondering what exactly might be driving this willingness to pay. Is it more about affordability? Like for health insurance, I was curious, given that
most provinces have some sort of public health insurance scheme. So for health, I don't imagine too many individuals would have a demand for, I guess, personal health insurance. So what exactly might be driving this willingness to pay for, I guess, health versus life, or the other type of health, the other type of insurance services that were, I guess, studied?
So so I don't know if I've understood your question. So the question is what would be driving particularly this non-governmental health insurance, given that there is public health insurance, public health coverage, right, in the context of Canada. So just I should mention that I'm not that much familiar with the kind of health system in Canada. So, but one thing that I can say is in general, public health coverage and this individual health insurance are like complementary. They are not just as such substitute. They might, play this kind of substitute role because they just both, give coverage to health risks in that sense. They might be substitutable goods. I understand that, but they also play some sort of complementary role. Actually, people in this survey, the people have been, the respondents have been asked about their satisfaction as far as the public health coverage is concerned, whether they are very much satisfied, somehow satisfied, not satisfied at all, and these kind of questions were asked, and therefore, and also they just this questions related to, say, for example, the health risk events and the kind of cost that they incurred, and the coping mechanisms, coping strategies have been asked as well. But from there, just my understanding is that even in the case of people who tend to, say, for example, less satisfied with the public health coverage might opt to buy, say, for example, individual health insurance. I think that is the case. I think from my reading recently related to, say, for example, studies in the context of developed countries at large, even in countries where there is some sort of universal health coverage, individuals tend to purchase, non-governmental health insurance because of partly maybe the dissatisfaction that they might have with this the public health coverage. But yeah, like I mentioned, my understanding about the health coverage, health system in Canada is very much limited. Sorry about that. Yeah, I'm sorry. I don't know if I responded to your question or not.
Right. Okay.
For this part, because I was a part of the survey with Vida, the idea was about dental insurance mostly and prescribed drug insurance, because in Canada, dental is something that is part of the extended health insurance package, and drug insurance is also something that is not really covered by the government in many instances. So there are some gaps, and this is what we think drives the health WTP. I have a few questions, but first a comment. Maybe I missed something because there's a lot of numbers in the presentation, and I don't really like numbers. But you have a slide where you, I guess, summarize the change in WTP as against the change in I guess preferences, right, or risk averseness. If you go to the slide, I believe it was recently, yeah, here, but yeah, this is the slide. So it says, for example, predicted probability of participation decreases on average by between. No, this is the probability. There was another slide about the willingness to pay, I think, where there was something about dollars. Oh yeah, this is the one. So a unit increase in the positive view index, for example, raises WTP by between blah blah blah, right? So don't you think that because as far as I remember the survey, people were given some precise, I guess, numbers, figures in terms of the amount, right? So are you willing to pay $1, $2, $3, $4? There was a set of numbers. Do you think it's more natural to give this increase in terms of relative rather than absolute values? Because when you say the premium, for example, when you say my willingness to pay increases by $1, right? I mean, what does it mean? $1 is pretty much nothing, right? But if you say that I'm willing to pay 25% more because this is how this question was framed, it's a different story. And connected to this is also that you try to look at the amount of dollars as against a totally different unit, right? Where is it? This is again, I guess, a different slide. So the same slide that was talking about the amount of dollars, right here, it was comparing the amount of dollars that I'm willing to pay to increase in positive view index, right? So it's something that is not really comparable. This is why I think that maybe I'm wrong, but it sounds like it would be more natural to sort of conclude this thing here in relative terms rather than absolute dollar values. What do you think?
Yeah, so yeah, thank you for that. Yeah, so like I was like trying to explain this one because this way because when we in the question that they were asked, so in this seemingly continuous variable, right? So, so they were the kind of bidding reports, right? Say for example, for the cause of injury for policy one, they were asked whether they would be willing to pay 17, and they say no, like 15, and they say yeah. So it is a kind of numeric values that the premiums are. And therefore, of course, like you said, with the unit of measurement of the dependent variable, which is the willingness to pay, and the independent variable in our case, like positive attitude, negative attitude, or risk comfort, the unit of measurements are different because they are indexes, and therefore maybe drawing that kind of conclusion might be wrong. I should revise. I should reconsider that one. But I don't know if Toby gives us some sort of beta coefficient where we will be explaining the magnitude, maybe regardless of maybe the unit they were measured. But I should reconsider that one. Yeah, thank you.
It's not about the dependence. It's more about the units of how you really convey the message. So when you say they're willing to pay more between $0.6 and $2.6, right? But once again, they were offered to pay, I guess, based on the previous slides, between $6 to $18, right? So $2 increase sounds a significant increase. However, this is only because I know what they actually were offered to pay, right? If they were offered to pay, for instance, and this is not right, of course, but between $6,000 and $18,000, then this $2 increase is nothing, right? This is why I'm saying that given this message in terms of absolute values, dollar amounts, rather than relative values, in my opinion, is a bit misleading, right? But once again, maybe talk about that with you. My questions are this. So based on what I sort of heard today and what I remember, all the conclusions are pretty, well, let's put it this way, not really surprising, right? So if I'm super comfortable with the risk that I'm exposed to, I don't want to pay a lot, or maybe I don't want insurance. The better my experience with insurance is, the more I want to pay. All those conclusions are pretty, I guess I don't really need to do a study to really assume that. Have you found anything that is surprising while working with the data?
Yeah, so yeah, the thing is like maybe the predisposition that people have, toward this risk is something which is a bit interesting. I mean, because people there might be some sort of prejudice about people's attitude toward this risk, right? Because the result that shows that the effect of risk attitude depends on the risk event shows us that when people are exposed to some sort of risk events, right, like health events or something, right? So the effect of this their attitude toward this the likelihood of risk event happening, serious event happening is low, and that the likelihood that they can manage the events even if they happen would, that effect would be, like decreasing, meaning because the interaction term appears to be positive. So yeah, so my understanding is maybe, some sort of literacy about, and awareness about risk, and again, the probability of the risk event happening, and the mechanism of coping strategy, I think is maybe essential. I think that is the kind of, implication that it has. So yeah, that might be something, interesting. Yeah. So the conditionality of the effect of risk comfort on risk event is something that appears to be more interesting that in my area probably. Yeah.
I see. Okay, thank you. My another question is about the definition of inclusive insurance, because so what I remember from listening to other people and when looking at your slides as well. So for example, there's this micro insurance, right? That usually also has a problem when being defined, but people say low premium, low face amounts, and targeting low income population. This is micro insurance, more or less, right? Roughly speaking, correct? And then you say, well, inclusive insurance, we switch from unserved to underserved, right? So we actually change the target population. Don't you think that maybe the right definition of inclusive insurance is maybe, I was just thinking about that when listening to you, so it might be totally immature, but maybe the definition of inclusive insurance has to be hinging on the characteristics of a policy in place, right? So it's not so much about low premium versus high premium, because again, for someone it can be low, for someone it can be high. Same with face amount, same with population. Someone who is underserved in Toronto can be super well served for some criteria in London, Ontario, right? It's all relative. But maybe there's a set of criteria, of characteristics, of traits of a policy that make this policy an inclusive insurance. Maybe every insurance, good insurance, has to be inclusive. And so if this is an approach to define inclusive insurance, then you can actually say, well, you give me a policy and I'll tell you whether or not this policy is inclusive or to which extent it's inclusive, right? Which then, why I was thinking about it, because we were thinking about a more sort of a larger idea about whether or not how well insurance is penetrated in the market, right? So we can then maybe speak about whether or not the nature of majority of insurance policies being inclusive is actually contributing to the penetration measure of insurance in the market. And it also is connected to what Michael McCord is saying, but differently. He is saying that basically, again, roughly speaking, every microinsurance, he's dealing with microinsurance, of course, every microinsurance has to be suave. I don't know if you heard about it, but suave is, I guess, simple, understood, valuable, efficient, and I don't remember what else, right? So every letter stands for something. So I'm saying maybe there is, so what he's doing, in fact, this is his guiding line for creating microinsurance policies. But maybe this can be an idea to define what inclusive insurance is. What do you? This is just one idea. It would be good to hear your opinion about it.
Yeah, thank you for that. Yeah, so I was reading recently, particularly this Geneva Association's report recently, maybe that you shared the other time actually. So they said that micro insurance is a subset of inclusive insurance, and they claim that micro insurance is not a proxy for inclusive insurance, rather it is one component of inclusive insurance. Because they say, that for inclusive insurance should not be only like confined to serving the unserved, but also, it should be defined broadly. us like also serving the underserved ones, and therefore it therefore is not something. In the case of microinsurance, nature is more about, I think, related to maybe low income people, maybe targeting, say, for example, alleviating poverty, but they claim that this inclusive insurance can also, go for the middle income people who are also, having barriers which might not be just necessarily income, but others, like, say, for example, behavioral issue, attitudinal issue, whatever. So, like, you are proposing maybe, therefore, this can be, therefore, approached from the point of view of also the kind of policy, maybe like a high coverage, low coverage policy, and therefore associated to them being relatively okay, low premium, high premium. Maybe I think that can be considered.
Yeah. I frankly speaking, sorry, I didn't read. I know that I shared with you this Geneva report, but I didn't really read it, to be honest with you. I just didn't have time. But I don't really agree with people that say that. So my vision is this: I don't think that we need microinsurance versus inclusive insurance. I think that every insurance has to be inclusive, right? I do sort of agree with Michael McCord when he says that insurance has to be simple and understood and valuable, but also actuarially sound. He doesn't say that, but being in sort of, I do think that insurance has to be priced to risk, right? And I just think that every insurance has to be inclusive. This is why I was always arguing to actually not call what we do microinsurance. I wanted to call it inclusive insurance, because I think that insurance has to be inclusive. And your diagrams, when you look at the data that you collected, I believe one of the hugest things that really are easy to see is that people say insurance is expensive, right? And it's not just because insurance has a high price tag. Your first slide, I guess, was saying, yeah, right. So if you look at one of the most, I guess, where is it? Yeah, the religion is one part, but then there is something about expensive. Where is it? Expensive?
Yeah, here, this one. Yeah, insurance is very expensive, like almost 79% of your.
Yeah, exactly. So everyone agrees that insurance is very expensive, and I don't really think that this is always correct. It also partly coming because people don't really understand how it works, but it also comes because they don't really understand their policies, right? Policies nowadays are very complicated, not simple at all, not really understood, like based on Michael McCord's taxonomy, right? And people just don't understand and don't appreciate the complexity, and I don't think they have to, really, frankly speaking, right? So I think that every insurance has to be inclusive, but anyway, this is sort of my way of thinking it. Maybe the definition has to be a bit different, and then there is no need really in looking at low premium versus high premium, low face amount versus high face amount, underserved or an unserved or whatever, right? It's just based on the policy, right? Whether it's inclusive or not inclusive. And my last question is this. So you mentioned something very interesting that is actually also very natural to assume, that there's a high positive correlation. There was a slide that was showing high Pearson's correlations between something. I believe it was either preferences or willingness to pay. I don't remember what it was. There was a slide with row with yeah, this one. Sorry, yes. So you say that there is a correlation coefficient between equations errors. So what are those errors again? Could you remind me what those errors correspond to?
Yeah, so the thing is like the initial estimation was about profit, right? So yeah, so we employed here the conditional mixed processing, because the assumption is, if we just say, for example, follow like this consumer decision making, right? So the policies related to whether it is health, non-governmental health coverage, disability insurance coverage, or life insurance coverage, they are outcome of, like the same constraint optimization, right? That household space, right? And therefore, the error terms in these three different, equations. Therefore,
This part I do understand, Jeleta. I'm asking about, so you have those row, right? Row hat, which are the estimates of the correlation. This I do understand. And then you have three factors here. So the correlation between 1 and 2, 1 and 3, and 2 and 3. Who are those 1, 2, and 3? Is it life?
Yeah, the two is like non-governmental health insurance and the disability insurance, while 1 and the 3 is non-governmental health insurance and the life insurance, and the 2 and the 3 are disability insurance and the life insurance. Yeah, so the error terms of those different equations. Therefore, they are correlated and they're positive, meaning therefore, the participation decision in one area is, interrelated with the participation decision in the other area. And then I think that is intuitive because, they are outcome of the same, constraint optimization that, also space. Yeah.
Well, I take it not simply because of the optimization. It's I think, in fact, driven, let's think about it maybe later, but I think it's driven by the fact that there are latent variables that are driving these two processes. Or let's think, for example, of a random variable, 3 random variables, right? So you have your probit, whatever you do there. So let oh. Can you still hear me?
Yes.
Oh, so sorry, maybe I'm actually talking too much because maybe we don't have time. But I'll tell you very quickly, and if you think that this makes sense, let's maybe discuss it a bit later. But what I'm saying is that most probably it's a stochastic explanation to what you have here, because even the preferences, the risk preferences that play so strong roles in how people actually react to those life and disability or whatever insurances, they are latent, right? And they drive most probably people's willingness to pay or whatever else when related to those different insurance coverages. So my point is, maybe there's an opportunity here to actually use some models to predict or estimate those latent variables. For example, risk preferences, where you have those non-ordinal, I guess you have some ordinal variables as well, but mostly I think either non-ordinal, maybe ordinal, but you don't have a lot of continuous variables in the data at all, right? Maybe there's an opportunity here to actually use some estimation techniques for estimating latent variables in the data and really be able to estimate those risk preferences across different populations and ages. And I will stop talking now.
Thank you. Yeah,
Thank you very much.
Thank you. Yeah.
All right, I think that concludes our colloquia today. Thank you everyone for joining. Thank you Ed for the thought-provoking questions, and thank you Jeleta for the informative talk.
Sorry, Maya, you will miss the time when I didn't attend and didn't ask me. Thank you, everyone.